Over recent years, Australia's productivity performance measured by output produced per hour worked has slipped, as you can see in this chart. Indeed, the level of labour productivity in the December quarter last year was the same as it was 3 years earlier. No growth at all. This compares with average growth in labour productivity of 1.25% per year over the previous 3 decades. The fact that the supply side of our economy is growing more slowly than it once did carries the implication that demand also needs to grow more slowly than it once did if we are to avoid persistently high inflation. Given the importance of lifting productivity growth, it was pleasing to see the Productivity Commission's most recent 5-year report. The good news in that report is there are plenty of ideas on how we can lift productivity. The task we all now have, both government and business, is to implement some of those ideas. I'm raising these supply-side issues because they matter for inflation and they help shape the context within which the board makes its decisions. The standard view is that monetary policy can look through short-term supply shocks. That's provided that medium-term inflation expectations don't adjust to variations in inflation caused by these shocks. If inflation expectations remain well anchored, inflation should return relatively quickly once the shock dissipates. And this means that monetary policy, most of the time, doesn't need to respond. On the other hand, if inflation expectations do increase and wage and price setting behaviour responds to the higher inflation, an interest rate response is required. And the more the prices and wages respond to a period of temporarily high inflation, the greater will be the need for interest rates to respond. The situation is a little more complicated when the supply side issues are persistent, leading to persistently higher price increases in parts of the economy. And here there's a greater risk that inflation expectations and price and wage setting behaviour adjusts. Again, if this were to occur, a more decisive monetary policy response would be required. Our current forecast is that inflation returns to the top of the target range, but only by mid-2025. And this forecast takes into account the supply-side considerations that I just discussed.